Warren Buffett, 12 mistakes every investor makes. Warren Buffett is publicly known to be the most significant investor in the world, with a career running for almost 80 years. Having started his journey at investing when he was as young as 11 years old, he now possesses knowledge and experience he can share with investors of the new generation. With that, in this video, we're going to share the mistakes every investor makes according to Warren Buffett. So make sure you stay until the end for the biggest mistake investors make, and you could increase your investing profits massively. Let's get started. Firstly, missed opportunities. While many believe that the most significant mistake an investor can make is one that results in a financial loss, Buffett argues that missing an opportunity is more crucial and costly. These are investments that investors knew had the potential, but they never invested in. According to Buffett, he would have made profits of up to $10 billion if he had only acted on the opportunities that presented themselves. Missed opportunities can be seen as lost potential and may significantly affect the investor's long-term investment returns. It can be challenging to determine missed opportunities, so staying up to date with market trends and developments, as well as conducting in-depth research and analysis, and knowing when to act on opportunities that arise is key to investing success. Opportunities missed can no longer be brought back, but what matters is that investors learn from them so as not to make the same mistake again. Next, selling too soon. Buffett believes in longevity. He knows that owning businesses with great potential is a good investment strategy, as it allows investors to benefit from the success of these businesses. Owners of franchises, profitable farms, or apartment buildings do not let economic slowdowns pressure them into selling their properties. They hold on to their businesses for a long time because they know they have a massive value in the market and will succeed long term. As such, Buffett suggests that stock owners adopt the same mindset. Owning stocks is similar to owning portions of businesses. If investors own businesses, they must have a strong mind and not be influenced by economic market fluctuations or industry changes. What investors must focus on are not short-term shifts, but long-term success. Let's look at the next mistake, and that is buying cheap. During his early investing days, Buffett looked for cheap investment opportunities that had great potential. He invested in companies with low price-to-earnings ratios or assets that were undervalued. He profited from these investments, but later realized he was not earning as much. He advises you should be buying excellent businesses at a fair price. Do not buy fair businesses at an inflated price. This became Buffett's new winning strategy when it came to investments. He concentrated on businesses that had competitive advantages, outstanding management, and exhibited long-term growth. He knows these businesses will produce high returns in the long run. This practice of Buffett further emphasizes his belief that investors must focus on long-term investments and not on short-term market fluctuations. Investing in the right businesses will result in greater returns and a more stable portfolio. The next mistake Buffett avoids is investing in airlines. Buffett advises investors to avoid airlines, as he made the mistake of investing in them in his career and was burned. In the late 1980s, he purchased stocks in U.S. Air. Unfortunately, the company soon faced financial trouble, which put his investment at risk. Buffett concludes that airlines are not worth investing in due to the industry's unpredictability. It is also significantly affected by various external factors such as weather conditions, global events, labor negotiations, and fuel prices. Buffett knows it is better to invest in other businesses that are more stable and successful. The next mistake is not having a strategy. Buffett knows how to take advantage of every opportunity, no matter how small. He believes that little actions can lead to outstanding results. Success results from being consistent in making investments over time. More often than not, the lack of strategy led to missed opportunities. According to Buffett, investors should start small and compound their returns as time passes. After all, small investments accumulate in the long run, and disciplined, consistent investors naturally earn significant wealth. The next mistake is not to buy Amazon stock. Buffett was once asked why he did not choose to purchase stock in Amazon. He admitted it was a huge opportunity he missed. According to him, as much as he admired the company, he felt that the price always seemed higher than the model's power. He said he did not fully understand the model and had doubts then. Now, he wished he didn't make that mistake of not investing in Amazon. Indeed, investors must not invest in businesses they do not understand. However, before saying no to a company, investors must study and analyze its nature to understand fully how it works. Business people know when to make partnerships and with whom. It is crucial to establish relationships with experts in different fields to ensure every opportunity is taken advantage of. Before we continue with the list, please subscribe and hit the like button. It really helps us to bring you more finance, business, and investing content. And please don't forget to turn on the notification icon so you won't miss out on my latest videos. Let's continue with the next mistake, and that was missing a chance to invest in Google. At the 2017 Berkshire Hathaway annual shareholders meeting, Buffett admitted that he did not purchase shares in Google years ago when it was getting $10 per click. He said he refused to invest in tech stocks because he did not understand completely how they worked. He regrets not doing more research to comprehend how the business worked, even though he was a client of the Google ad business. Next, we have overestimating select manufacturing, service, and retail investments. Buffett emphasizes that he overestimated the potential of other businesses, which later on proved to have generated poor returns. According to him, in most cases, he had wrong evaluations of the economic dynamics of the company and the industry. There were instances where he also wrongly evaluated the people in charge of the companies. It is crucial for investors to not back companies blindly. In cases where they are not deeply familiar with the industry's nature, they must know to either pass on it or ask for advice from an expert. A personal mistake of Warren Buffett, according to himself, was buying Berkshire Hathaway stock. In 2010, Warren Buffett confessed that the dumbest decision he ever made investment-wise was purchasing stock in Berkshire Hathaway. He recalled that his first investment in the company was in the 1960s when it failed miserably as a textile company. He thought he would profit more when mills started closing, so he invested more. Later on, the company attempted to deceive him into spending more money. When he realized what they were trying to do, Buffett took control of the company by firing the manager. He kept the company running for another 20 years. Buffett said this move cost him $200 billion. Investors should be wise not to let their emotions take over, especially when making financial decisions. It is essential to always be rational when handling businesses and investments. The next mistake is overtrading. Investors who overtrade in bull markets risk losing more money in the long run. Buffett suggests that investors should adopt a more calculated approach instead of jumping in and out of the need to make a quicker profit. One investing model Buffett finds effective is the punch card system. This allows the investor to stop before investing, to think, if I could only make 20 investments in my whole life, would this be one of those 20? Once all 20 punches have been used, investors would be forced to stop making new investments. Instead, they should hold on to their current investments. This practice helps them think more critically and carefully when making decisions. The next mistake is following the crowd. Irrational investment decisions usually come from following the herd mentality. This may lead to significant losses. Buffett advises investors to have an objective view and not get carried away by the crowd. They must know to invest in companies that aim to stand firm even after many decades and have the potential to overcome market volatility. Bull markets allowed Buffett to build up more cash by making a few investments only. He said he liked making investments through bear markets, where he could use his built-up money to purchase lower-priced stocks. He stayed loyal to his strategy and did not let the crowd overwhelm him. The biggest mistake one can make when investing is not doing research. Before making any significant investment decisions, investors must examine and analyze a company's financial statements. These include revenue, earnings, cash flow, and debt levels to ensure the company is financially capable. They should also assess the market trends and the industry's state to determine possible challenges they would encounter. It is undeniable that Buffett has had his fair share of mistakes in investing. Now, he is one of the most successful investors of all time. Never forget that making mistakes and learning from them is a step you need to take on the path to success. Watch this playlist next, subscribe, and turn notifications on. See you in the next video.